Well, good afternoon and welcome to today's webinar on the U.S. economy and what to expect in 2024. My name is Scott Kozak, and I'm the Director of Learning and Development here at Union Savings Bank, and I'll act as the moderator for our topic this afternoon. We have three great speakers lined up to present, but before we get to them, just a couple administrative notes off the cuff. You'll be in look and listen only mode for the duration, which means we can't hear or see you, but hopefully you can see our slides and hear us just fine. Questions are encouraged throughout, so if you have questions for any of our speakers or topics today, go ahead and log those in the chat, and we'll pause periodically to field those questions as they come in. And lastly, but also importantly, there'll be a brief survey that once we conclude and end this webinar, it will pop up in your browser. There should be a link to click to participate in the survey. It'll probably take you all of 2 minutes to complete, but your feedback is very important to us. It helps us shape future topics of interest for all of you on the call today. So without further ado, I want to introduce our first speaker, Mr. Wirtz. He oversees all investment activities for our wealth management group. His responsibilities include the formation and implementation of investment policies and strategies. He's got over 30 years experience in the investment industry with a specialty in portfolio management, fiduciary oversight, and economic analysis for the USB team. Moreover, he is directly involved in managing portfolios for individuals, pensions, and not-for-profit institutions. Keith has earned his bachelor's in finance from Arizona State University, his master's in investment management and security analysis from Creighton University, and he also is a CFA holder, charter holder. So without further ado, Keith.
Great. Thank you, Scott, and good afternoon, everyone. Glad to have you join for this afternoon's discussion. Scott, if you can maybe turn to the agenda page, that would be great. The way we look at the world, we have a tendency to reference everything and all of our experiences in terms of the calendar itself. And so as you can see from our agenda, that's how I've segmented this. This is typically how we look at things on the investment side here at the bank. We're going to take some time to look at year 2023 in review. We've got 2 weeks left in the year, so in my eyes, basically the year is over. And then I'm going to spend the heart of my discussion this afternoon on the big macro issues that we focus on here at the bank. We're going to be looking into the issues around the U.S. economy, touch on the conditions right now on the inflation and whether or not that problem has been solved. We'll visit with the Federal Reserve and their policy trends that are in place. And then lastly, I'll give you a discussion around the capital markets. And throughout this discussion, it's my intention to give you insight as to what the consensus view is today, where it stands on certain of these variables. And then I'll profile it side by side with our outlook here at the bank as well. So with no further ado, let me go ahead and get into the discussion with everyone. Let's start with last year in review, 2023 in review. And as you can see, I think the big surprises emanate from two things that were expected when the year started. Wall Street was expecting a recession in 2023. It never happened. We're actually pacing to finish the year somewhere around 2.5% real growth in the economy here in the U.S. And that's much better than what people were expecting back in January when the year started. The other big surprise in terms of the view that was established a year ago was that people were expecting a bear market in the stock market. People were really bearish about the stock market, and clearly that has not happened as well. And as you can see from the scorecard, we've got some really fairly decent metrics that we can point to. We've seen moderation in inflation. We've seen a pretty resilient labor market, and that's been a real positive as well. The two big negative surprises, again, the volatility that we've seen in the credit markets, as well as what happened in the Middle East. Those are the two things that I think were the negative stories for this year so far. Now, if looking at last year, this year as it's ending, here's the scorecard, and these are returns based on last Friday's closing values. And you can see on the left-hand side the scorecard for the stock market, the bond market, and the international stock market. The year-to-date returns are all pretty much positive, really big numbers. As we sit today, the S&P 500 is up almost 25% with this week's rally. So we're seeing really, really generous returns emanating from the capital markets. One of the things I'd make note in terms of the stock market, it's been somewhat concentrated based on certain investment themes like artificial intelligence, et cetera. It's been an environment where growth investing has really been the favorite style investing, and it's done pretty well this year, much better than value or the core blend area of the marketplace. Two things I wanted to know. As we sit today, cash equivalent yields, what cash is providing as a return, is somewhere north of 5%, say 540, 545. Pretty nice returns coming from cash. And that's really been an attraction to a lot of investors who have suffered through 2 years of volatility, 2 or 3 years of volatility during this pandemic environment. The other big surprise, we've had these great returns this year in the stock market. I looked at the S&P 500 about 5 minutes ago. It stands today at a yield at a price point of 4,719. That's basically where we were 2 years ago. So we've gone through 24 months of substantial movements in the marketplace, but we're basically right back where we were at the end of 2021. And to give you that kind of perspective, I think a lot of people forget the fact that this year's been really great, but it followed what was a very difficult 2022 period as well. Now, if we turn to the next slide, Scott, before I begin my 2024 outlook and some of the information associated, we wanted to go ahead and ask a polling question. Let me turn it back over to you, Scott, if I could. I guess the question really goes to, as we look ahead, what is your opinion? How do you feel about next year's circumstances here in the U.S.? Do you see a recession in the U.S. economy next year, yes or no? Just wanted to get a temperature read from everyone on the call today.
Okay, the votes are coming in. We'll leave it open for another 10 seconds. We're about 62% of the vote in.
This will be interesting. It'll give me a sense of how people are viewing the world. Are people bullish or bearish?
Final 5 seconds. All right, nice sample. Go ahead and share these results.
Wow. It's a little less than a coin toss. It looks like there's some bearish sentiment in our crowd today, and that's I find that interesting. After what we've just come through, but again, let's get into the information, and I think you'll find it useful and informative. Some of the things I'm going to talk about now, as we look into 2024, I think a couple of things that I would mention is that these are the variables that here in the investment group we focus on throughout the year. These are what we consider big macro variables. So they're important to how we frame the world and how we look at our decisions. And I think one of the things that I would mention is that if we provide you our expectations for next year side by side with the consensus, you might find that somewhat useful. So that's the intent throughout this discussion. Looking at the first slide, let's start with the first variable, the economy itself. You'll see in the bars in the chart on the right-hand side, those are the quarterly real GDP measures that has been posted for the U.S. economy. The fourth quarter is expected to come in a little more than 1%, but you can see over the course of the last 3 years how things have been pacing. And we avoided the recession in 23, and we've enjoyed what might be about a 2.5% real growth this year. As I think about 2024, our point of view today is that we think the U.S. economy is going to continue to grow, but things are slowing down. And we're forecasting for next year real growth at around 1%. Now, let's on the next slide, let me give you some insight as to what the view is on Wall Street. The Bloomberg organization does a survey every 2 weeks of strategists and economists, and they register that information into a consensus kind of survey database. This is the U.S. economy table on the right-hand side of those survey respondents. You can see the 2023 forecast as well as the 2024 expectations by this group of forecasters. And you can see it broken out by the components of the U.S. economy as defined by the U.S. government. The big changes that they're looking for next year starts with the consumer. The consumer and households here in the U.S. represent about 70% of our economy, the activity within our economy. So that's a huge variable, something to watch. And that's one of the reasons why we're thinking that it's going to be a below average experience next year. We think that the consumer's somewhat extended and will start to retrench, and we're expecting a pullback coming from households in 24. You can also see the other variables. The U.S. government spending is going to start to trend lower. Some capital investment is going to take place and some trade activity, but by and large, Wall Street's expecting about 1.2% real growth next year. We're modestly more conservative than that. We're thinking maybe 1% next year. Now, one of the things that they also asked the respondents, what's your probability of a recession next year? It was really high a year ago at this time. It was close to 70% expectation for a recession in 23. As we sit today, the respondents, the survey consensus number is around 50-50. So it's a coin toss. And I think somewhat reflective of the survey we just took with you is that I think there's a real mixed view about what might be the case next year. The drivers, again, next year, we think are going to be slowing consumer spending and what's going on in the other components. But this consumer is going to be the big variable next year. You turn to the next slide. One of the important elements of the economy itself is the labor market. One of the reasons why we don't think we are going to experience a recession next year starts with the fact that we have a pretty healthy jobs market. We've got a situation where over the last 3 years, ever since the pandemic hit, we've had imbalances, substantial imbalances in terms of supply and demand. We've had tremendous imbalances within the labor market. But one of the things that unfolded this year that was a real positive is that we saw a normalization, kind of a healing in the labor markets here in the US. We saw more people coming back to work. We saw what I would refer to as a rising or recovering labor supply in the marketplace. And the demand for labor, the companies looking to hire, that did not accelerate. In fact, that's somewhat moderating as well. And so the imbalances that were causing all kinds of problems in the labor markets, we're seeing signs of a real rebalancing and an improvement there. The other is that wage growth, which was high single digits, that's moderating as well. And so those are conditions that we think spell a better employment condition. And we think that's going to at least give us some basis for positive or at least an optimistic view for next year. You turn to the next slide. Let's get into the next topic, which is the inflation arena. We've experienced 24 months of challenge in the inflation measures, CPI, PPI, et cetera. And what we've enjoyed this year, and the graph on the left gives you a good sense of this. This is the PCE index, the Personal Consumption Expenditures Index that the Federal Reserve considers their preferred index measure. Over the course of this year, it's rolled over, it's come off the peak, and it's been moderating. And as we sit today, the last measure was 3% annualized, looking back 12 months. And so that's been a vast improvement in terms of the numbers and such. Now, one of the things that we expected when this year started was that we were going to see a rotation of pricing pressure within the marketplace. During the pandemic, people were locked up, they went remote, they stayed home, and a lot of consumption took place within households, a lot of spending on goods. In fact, one of the challenges and one of the reasons why we had this jump in inflation is we had people buying not only goods, but buying the same goods. And we had disruptions within the production side of this economy. And that created that blue line on the right-hand side, that big spike in inflation as it relates to hard goods, real goods. Now, over the course of 2023, household spending patterns have moderated or have modified. They've moved away from continued real asset or real goods consumption. And there are people now traveling. People are now looking to get out of the house. And the services side of our economy has picked up, particularly as it relates to the housing segment of our economy. And that's where we've seen kind of that chronic, that nagging inflationary condition that still exists in this economy. It's more on the services side. And make no mistake, that's important because this economy is 65 to 70% based on services. So this is something we'll be watching quite closely because of the idea that we want to get back towards the Fed's target, which is 2% kind of embedded inflation in our environment. Now, if you were to turn to the next slide.
Keith, can we pause for a quick question? There's a question that came in pretty relevant. Great question, by the way. So it says, given the real estate costs, both purchase price and rents that have remained high, even with the higher interest rate environment, if interest rates fall next year, even slowly, do you feel that our pricing problem will only get worse?
The way we're looking at the real estate market, the residential real estate market, it's somewhat locked up right now. It's not something we've seen before in that mortgage rates, the inflation on money went from 3% to almost 8% on mortgage rates. Huge jump. And that changed the whole equation in terms of how someone might look at their monthly budget to purchase a home. On top of that, when we had low interest rates, we had a real resilient rising price market in the housing market. And so we've got what are considered almost peak pricing in residential real estate with rising cost of money, mortgage rates. And that's created this real challenge in terms of the real estate market. When I say locked up, what I'm describing is that people who are living in homes, they're not as transitory. They're not moving around as much as they used to. There's a great fear that if you have a 3% or a 4% mortgage, you don't want to transact, sell your house, buy a house, and take on a 7.5 or an 8% mortgage. And so the secondary market of supply of houses has really locked up. And the only real growth that we're seeing right now in the residential real estate market of any note is coming from the new household build side of the equation. And that's much more modest than the secondary existing home sales kind of situation. So even if we see mortgage rates coming down, because of this locked up condition, I think we're going to still be in this environment for the next year or two where housing costs are going to be inflated, and it's going to be a hard time for people looking to buy a house. It's just things are really locked up, and it's because of the interest rate markets.
Thanks, Keith.
Now, in terms of expectations for inflation next year, here are the numbers. You can see at the top, these are the forecasters on Bloomberg in terms of what they're expecting for consumer price index, what they're looking at the PCE price index, as well as core PCE index. For 23, these are the full year estimates from this audience. And when you look at 24, these are the forecasts coming from the survey audience. 2.7% is the forecasted CPI or consumer price index movement that Wall Street's looking for. In our view, we think we're going to experience a little bit more inflation than what the Wall Street consensus is. We're actually expecting for the full year that CPI inflation is going to average more like 3%. Now, make no mistake, we've seen a real moderation. We've seen things come down. We've got some base effects that will help continue to push things down, but there are some wild cards that are on our mind. We've got the service side of the economy, which is still naggingly holding up in terms of price pressures, as well as we think energy next year might be the wild card. So those are things that lead us to a point of view that we think we're going to endure more of a 3% kind of inflation rate next year. If you were to turn to the next slide, we're going to shift into the Federal Reserve itself. Topic number 3. If we think about the Federal Reserve, they started a interest rate increase or hiking cycle 2 years ago. And I put on display on the right-hand side, the first increase in rates occurred in March of 22, and they've been adjusting the policy rate ever since, by and large. And you can see since that time, all of the meetings that have taken place and what the actions were of the Federal Reserve. The good news is the last rate increase occurred in July of this summer. There was a 25 basis point increase on the policy rate. And as we sit today, we've got a policy rate, the short cash side of the equation, in the policy range of 5.25 to 5.5. That's where we're at. We believe that the Fed has reached their terminal level in terms of interest rates increases. And now the question is, how long are they going to hold that policy rate? What's occurring right now in the bond market is a major repricing of securities in anticipation of a pivot by the Fed early next year. What we're seeing right now is the expectation from Wall Street that rates are going to start to come down pretty early next year. But right now, what you've got is a tightening cycle that we think is near the end. We've had 11 rate increases, and we think that the question now is how long are they going to hold the policy rate elevated, and at what point might they start to turn things around? Now, if you turn to the next slide, Scott, let's go into this. This is a question, I guess, about interest rates and about the markets. But if we can skip that for a second, I just want to get to the second slide, the slide thereafter. Well, I think I'm actually missing that slide. Can you go back up a couple? Anyway, I think it's out of sync. But what I was going to describe is right now what's been priced in the into the capital markets. The kind of signals I'm seeing is that we're expecting rate cuts to occur starting in March. And Wall Street's looking for 4, maybe as many as 5 rate cuts next year. And the policy rate today, which is around 5.5%, the consensus view emanating from what I see in the signals from the marketplace is that we may see the Fed funds rate near closer to 4% when the year concludes. Our view is that the Federal Reserve is going to hold that policy rate for a while. Their reputation has been damaged as a result of this spike in inflation. And we believe that they're going to want substantial confirmation before they actually consider a pivot. In fact, we don't think they're going to consider a rate cut or a pivot on monetary policy until such time they're compelled to because of perhaps weakness in the economy. So we're thinking that any rate cuts, if they occur, it's going to happen in the second half of next year. Now let's get to the question, and we'll pose it to the audience. I'm going to go into my last area, which is expectations around the investment markets next year. Before I share my thoughts, I'd like to go ahead and get your thoughts in terms of a quick polling question. As you look into next year, what's your simple expectation? Where do you think you're going to get the best returns? Is it going to come from stocks? Do you think bonds are going to give us the optimal returns, or do you think cash will be the best returning class next year? What are your thoughts in that regard? Just wanted to get a quick survey on everyone.
And we can do two at once. So while those votes are coming in, we did have a chat question that I'll pose to you as that's coming in, asking did you note an increase in unemployment next year, and if so, why?
We did, and that's also consensus. I think the consensus on the street is that we're going to see as a slowing economy and maybe a slowing of business activity, that companies are going to be expense minded, and perhaps we're going to see the unemployment rate, which is the metric a lot of people focus on, we may see that tick towards 4%. Make no mistake, when this year started, the point of view was that we're going to see an unemployment rate at 4.5% right now when this year is ending. We've had a really strong, resilient marketplace, and I don't see that creating huge dilemma, but that's one of the leading indicators we'll be focused on. If there's concern about a recession, I think the thing you want to focus on is to look at the information around the labor markets. That's going to give us, I think, a sign of where things are going.
Thanks, Keith. All right, we're going to go ahead and we had a nice sample. I'm going to go ahead and end poll, share results.
But it looks like most of the participants are looking for the stock market to give us the best returns next year. About a third looking at the bond market, and I think those that are in the bear camp are looking at cash maybe being the preferred investment next year. So that's interesting. Let me walk through what I see from Wall Street as well as our point of view. This is a display of two yield curves. The yield curve as of Monday and the yield curve on March 9 of 2020. And the reason I picked that particular yield curve is I wanted to bring to your attention, that's the day in the bond market that I think we reached the 40-year bull market end. That is the moment in time where I think interest rates in the treasury market reach the lows that we'll never see again. I think that's the lowest yield curve that I'll see for the balance of my investment career. And I would suggest it's going to be the lowest level of interest rates all of you are going to see for the balance of your working life as well. That was a particular, an extraordinary moment. And you can see how far we've come as a result of Fed policy. Federal Reserve, through their policy actions, has pushed the yield curve up 4 to 5%. It's been a huge change in the credit markets, and that affects everything else. But I just wanted to start with that slide because I find that really informative about this decade. You turn to the next slide. This is the slide I was searching for when I was bouncing around a second ago. This is a signal coming from Wall Street. These are derivative transactions for people that trade interest rate contracts. And what this demonstrates in my mind is if you look at where I've got the arrow current slide, it's under the current policy range of 5.25, 5.5. The forecast from Wall Street coming into yesterday's meeting was that it was likely 97% that they were going to leave rates unchanged, and they did. Now, if you look at the contracts and the signals coming off the Merck Exchange model for where rates might go over the next 6 to 9 months, or for the next year at least, this is what people who are trading and hedging risk are signaling through their transaction activity. They're expecting by the end of 2024 in December that the strongest odds are that we're going to see interest rates near 4 to 4.25. That's where people are placing and hedging their risk right now. And you can see that built into transaction behavior and how capital is being exposed and how risk is being hedged. Expectations are we're going to see a near-term pivot starting about March or April, and we're going to see this pivot take place and push rates down near that 4% threshold. That's going to be one of the big questions next year. When does the Fed take that pivot, and how far do we see rates adjust next year, and to what extent do we see that yield curve that today has a a negative, unnormal, or unusual slope, when does that go away? It's our view that the Fed's going to wait until this later in the year, and it's our view that we're going to see lower rates as the year finishes, but not near the 4% threshold. We think we're going to be in the mid fours when the year ends. So we're a little more, sanguine about the idea that we're going to have a real resilient condition in the environment, or in the interest rate environment. You turn to the next slide. What about the stock market and the bond market? Is it going to be a bull or bear condition next year? And I think most of you are expecting at least stock market returns to be positive and pretty generous. And so I think there's a bullish sentiment on this call at least. But let me walk through some of the numbers as well. As we look at the Treasury and the bond market, on the right-hand side, you'll see a snapshot of the main Treasury active securities, the 2-year out to the 30-year securities. And on the far right-hand side, you can see where yields were 2 days ago. The current yields on these instruments were in the low to upper fours. It's our view that as we go through next year, we will see eventually a falling rate environment, and we'll likely see yields and total returns are going to be equal to or better than that yield curve column on the right-hand side. So the phrase that I use is that if you buy a bond at 100 cents on the dollar and the coupon's 4.73%, for example, on a 2-year, you're going to earn that coupon. You may get some price appreciation on top, and so you may earn a coupon plus some price movement to give you a pretty decent return in the bond market. And so we're expecting a really improving bond market, and that's really good news, because for the last two and a half years, nothing but volatility and struggle in the bond market. We think next year is going to be a rewarding experience for bond investors. If you turn to the next slide, for the stock market, here's our best case view. Today, we're standing around 47 on the price level. That's as of today. And we're expecting next year that we're going to see improvement in corporate profits. A lot of that's already been priced into the marketplace. Wall Street has a point of view that we're going to see the index itself rise substantially above 5,000. Excuse me. The expected or projected return coming from Wall Street right now, from the analysts on Wall Street, is a return experience from stocks, total return of almost 8%. And if you think about earnings plus valuation change, you can see what Wall Street's kind of math is. They're forecasting EPS growth for the S&P 500 companies of almost 12%. To get an 8% total return, that means we're going to see some compression or contraction in valuations. This year has been all about valuation expansion. If you look in the 2023 experience up at the top, earnings have been pretty much flat. We've had an earnings recession almost, but we've had better than 20% returns on stocks, and it's coming from valuation expansion. What that means in my eyes is that the market's pricing in expectations for earnings growth next year. That's what this year's return experience is all about. The market's preparing for what they think will be a generous, strong fundamental condition for U.S. companies next year. We are a little more sanguine. We're expecting EPS growth to be less than 10%. And as a result, we think that the market's a little ahead of itself. They may be priced in a little too much optimism. So our expectation for stock returns next year is positive, but more in the low single-digit range. So we're a little more cautious about stock investing next year. We think we're going to experience positive returns in stocks, bonds, and cash, but we actually think the bond market might be the place that will give us the most generous returns as we look through next year. Turning to the next slide, Scott. A couple of things, risks on the horizon. One is the election itself. I know I'm going to be asked several times throughout next year expectations I have about the election. I found this information interesting. Nationwide Insurance in Ohio did a survey of investors about a month and a half ago, and they asked the question about the 2024 election. And the summary of the response from their investor respondents was that 45% of the respondents felt that next year's election was going to have more of an impact on their retirement account than what the markets in general might otherwise provide them. So there's a lot of worry going on right now amongst the survey respondents about the election next year. And about a third of that audience as well is convinced that depending on which candidate and which party takes control of government, that's going to dictate the condition of the U.S. economy thereafter in 2025. So there's it feels like a real polarization, or at least a real anxiety that's in the voting base, the investor base right now. And so I think the election next year is going to be really, really important. You turn to the next slide. The one thing I would say about the election, and I wish I could give a better answer, I'm going to dodge any forecast about the election next year, and I'll tell you why. What I've come to recognize over the last 3 election cycles is that the way we process elections is dramatically different. We don't vote nearly as much on election day as we used to. Most votes are cast well in advance of the November election day, and most votes are cast by mail-in ballots. And I think that's altered how elections actually are concluded. And I think the polling data and the sentiment survey data, some of the things that we've used in the past as indicators of how the election might turn out, they just don't work anymore. I have found that I can't rely on historic predictors to paint a picture about the election outcome, because these signals have no predicted value anymore. So I have no clue what the election's how it's going to resolve. So I'm going to, like everyone else, we're going to just have to wait and see. It's going to be an important election, but I think it's really a hard one to predict. The second thing that's on my mind, just the last item I wanted to bring to your attention, relates to the fiscal house of the U.S. government. Right now, we've got fiscal spending activities that have accelerated because of the pandemic itself. And what I wanted to bring to your attention is the fact that I think it's leading towards some problems on the road, or down the road, for all of us. Right now, if you look at the 24 budget, the government has budgeted to spend for U.S. defense appropriation purposes a little more than $800 billion. If you look at what's the line item cost for the cost of carry of our national debt, right now it's at $745 billion. And the Congressional Budget Office is forecasting that within the next 8 years, we're going to see the interest costs on an annual basis eclipse the $1.4 trillion mark. What that means is we got issues related to the budget that might create a crowd out effect. You turn to the next slide. This kind of dynamic where we've got at the federal level so much spending taking place, that crowding out effect is an element of what I call a negative trend. And these trends aren't sustainable. And I put in here the fiscal 23 circumstances. This is what the government spent in the last fiscal year. We're in fiscal 24 right now. Last year, the government took in revenues of $4.44 trillion. The U.S. government spent $6.13 trillion. They added to our national debt at a rate of $2.24 trillion. Our national debt as of the end of the fiscal year stood at $33.17 trillion. And throughout the whole year, in terms of anticipated expenditures that were cut out of the budget, Congress is able to cut out $237 billion. So those are the numbers that came out of last year's actual at the government level. I try to put that into family household terms, and that's the table at the bottom. I dropped the last 8 zeros of the table above, and I said, let's frame it like someone might consider their household budget. A household with a hypothetical income of about $44,000 a year, who otherwise had spent $61,000 a year last year, and put on their credit card or cards $22,000, leaving a credit card balance of $331,700, and was able to squeeze out of their household spending activities $2,300. That is kind of the comparative or the analogy I would use to kind of frame it, to make it easier to understand. We've got a deficit spending condition that I think is not sustainable. It's going to create problems in the credit markets, and it's going to create disruptions to the priorities that we have at the government level. So I just wanted to mention this as a risk as well. With that said, those are the main themes I wanted to cover. Let me summarize again our outlook expectations. We're expecting inflation next year to pace at around 3%. We're expecting a policy pivot from the Federal Reserve, but we're expecting that later in the year, maybe later than what Wall Street's expecting right now. We're expecting positive economic growth next year, real growth, but more modest in the 1% range. We're looking for positive returns from stocks, bonds, and cash, but we think bonds might actually be the place that gives us the best returns. And as we look at the election next year, I think it's anyone's guess. It's going to be a real anxious election experience because I think it's going to be really hard to predict. So those are my macro comments, our outlook for next year. Are there any questions I can try to answer before I turn it over to my colleagues?
Really nice job, Keith. At this time, there's no additional questions in queue, but certainly if you think of one as we switch over to our next two presenters, feel free to log those in as well.
Great. Thanks, everyone.
Thanks, Scott. Thanks, Keith. Appreciate that. And, as always, Keith, we appreciate your thoughts. Obviously, none of us can really predict the future, but, I'm fairly certain that it's going to be an exciting year next year, and there's going to be a lot of opportunities in front of us. So I always appreciate your insights. I'd like to start off here with just a brief introduction for the sake of time, just for those who are unfamiliar with who we are here at Union Savings Bank Wealth Management. So my name is Chris Cavello, and I'm the head of financial planning here in the trust department. And alongside my colleague and fellow CFP, Brandon Angadi, we work to help individuals and small businesses, for that matter, achieve and identify their financial goals while also gaining a better understanding of their personal values. So in today's webinar, we'd actually like to take some time to discuss the world of estate planning and some of the opportunities that need attention as we close out the year here. We'll also touch a little bit on some additional gifting strategies that are adjacent to the estate planning world, and then wrap up with some high-level information around the programs that are available here in the state of Connecticut to assist. So to jump in here and get rolling, we have a polling question that I think is really helpful for us to just get a pulse as to how you guys are viewing the estate planning world. So has anybody here actually sat down with an estate planner, whether that's an attorney or CFP in the last few years? And Brandon, I think this would be a really interesting question because it'll give us a sense of who has started to think about these items that we're going to talk about already.
Yeah, absolutely. It's something that's important to review at least every few years, regardless. So
Votes are rolling in. We're already above 70%. We'll leave it open for another 10 seconds.
Perfect.
Very nice sample. I'll go ahead and poll share results. Here you are.
Perfect. And about a 50-50 split, which it's good. It means that people are starting to think about this here, but there's still a large amount of individuals out there that haven't. So hopefully we can help those that have been already by giving them a little more insight and also start to prep individuals that really haven't had a chance to look yet. So to begin, I think it's important to stop and actually look at some of the basics of estate planning and how we can remain vigilant about our preparation at the end of the year. You'll see on the screen here that we have an example of an estate planning checklist. We recommend that each year you take stock of these important items and ensure that they're reviewed at least every 3 to 5 years, or alternatively, immediately following a major life event. So this includes making sure that you have the 5 basic estate planning documents that are still there and meeting your evolving needs, because everything changes through time. And then making sure that your beneficiary designations all still apply. This includes contingent beneficiaries. I know a lot of us forget sometimes that you don't not only need a primary beneficiary on your insurance policies and IRAs, but you do need contingent beneficiaries so that if the beneficiary should predecease your contingents, we still know where that money is going. And we also want to make sure that we've accounted for all important items, both physical and digital. So this includes not only assets with monetary value, but also assets that have high emotional value. Even in today's modern times, we often forget that there are emotional digital assets that we have, like photos and videos, and they need protection. And your loved ones will certainly appreciate instructions on how to find everything, should you pass away. Finally, with the start of the holiday season, you're going to have a lot of opportunity here to discuss your estate planning intentions with your loved ones. Tax-efficient solutions are as important as the impact and legacy that you're going to leave behind. And the next generation often will benefit from being included inside of the conversation rather than excluded. To us, it's critical that we ensure that the next generation are good stewards of any legacy that they are set to inherit. So let's flip over. Thank you. Now that we've looked at some of the general end of year items, I think 2024 provides us with a fairly unique opportunity that is also fairly time sensitive. So the federal government provides every individual with a lifetime exemption to the very high federal estate tax rate. And in 2024, that rate will be $13,610,000, the highest it's ever been. So while this amount does provide a substantial opportunity to offset these high estate taxes, this opportunity is time sensitive. Under current tax law, the exemption is actually set to sunset as of January 1st, 2026. And at that point, it's going to be reduced to an estimated $7.25 million per individual. So what does this mean for us? It means that there will be a large increase in the number of estates that are subject to the federal estate tax, which can range anywhere from 18 to 40%. And this makes effective estate planning and proper gifting strategies extremely important, especially over the next 2 years when we have a little bit more flexibility in how we can gift. So when it comes to estate planning, and we can flip to the next slide here, there are two primary strategies that we have available to us. We can either look to reduce our taxable estate and therefore lower the overall tax bill that we receive, or we can look to create additional liquidity in our estate and create assets that address the taxes for our heirs. As you can see, I've listed a few strategies here to accomplish some of these goals. It's safe to say that we could probably have an hour webinar on each one of these topics and still not cover them in their entirety. So really, my goal today is to give you a very high-level overview of what these strategies are so that you can see the value of detailed estate planning, but I highly recommend that if anybody has interest in learning more about how these strategies might directly impact you specifically, that you reach out to a CFP, certified financial planner, or an estate planning attorney. Brandon and I obviously have quite a bit of expertise in this world, so we can absolutely make ourselves available to have a more detailed discussion with anyone. But really, it's more important to us that you're taking the step of reaching out. So if you have somebody that you already trust, please reach out to them. I mentioned before that the exemption will sunset as of January 1st, 2026. So although that seems like it's a lot of time to plan, it's 2 full years really from where we are now, many estate planning attorneys are actually already booking appointments well into 2025 because there's just such a high demand to get these things done and built before the deadline. Because not only do you have to build certain documentation to establish these trusts and these strategies, you then also need to make time to fund them. So the sooner you can get started on these items, the better. So looking at the strategies listed, you'll see that many of them actually involve trusts. These trusts are all considered irrevocable trusts by nature, which they'll differ from what we call revocable living trusts, which we saw on the estate planning checklist earlier. Many of you likely already have revocable trusts in place to help create privacy in your estate and to avoid some of those costly probate costs. Irrevocable trusts differ in that in order to remove the assets from your taxable estate, you're gifting them into a trust that has a full separate tax ID, and this gift can't be revoked. It's in the name, right? Essentially, you're giving up control and beneficial interest in an asset in exchange for removing it, and more importantly, all of its future growth from your taxable estate. That being said, you will still have created these trusts with your attorney, right? So the language in the trust or their purpose will have already been defined by you and your goals. For example, a SLAT, Spousal Lifetime Access Trust, the type of trust that removes the gifted assets from the taxable estate, and again, all the future growth, but it allows the non-donor spouse, so your wife, your husband, your partner, whoever it might be, to benefit from those assets while they're still alive. And this means they can request income to fund their expenses and fund their lifestyle. But ultimately, the principal assets, the one that the assets that you contributed to the trust and gifted to the trust, and any accumulated growth in that trust are passed down to the named remainder beneficiaries that are inside of the trust document upon your passing. A QPERT, there's a Qualified Personal Residence Trust, does the same thing, but it's designed specifically for the donor's primary residence, which comes in very handy if a large portion of your estate is tied up in a large real estate property. CRTs, so Charitable Remainder Trusts, and then GRATs, Grantor Retained Annuity Trusts, that one's a mouthful, are similar as well, but they're designed to include other individuals in the process. And this could be charities, it could be other family members, Where it's really important is in children from first marriages. So obviously, divorce creates a lot of wrinkles in our goals. These trusts really help, and the list goes on. We can go on forever there. Now, the other side of the coin, which is creating liquidity, applies when either you've already used up your entire exemption, or you have assets that, for whatever reason, you're unable or unwilling to gift into the trust at this time. So the best example of this would actually be using life insurance inside of a trust. So number one item we have on there is irrevocable life insurance trust, or an ILIT. This can be done with something as simple as a survivorship life insurance policy, which is something that has the requirement of both individuals named on the policy to pass away, therefore makes it a little bit cheaper. Or it can get very complex, with the design of a powerful cash value accumulation policies. In both cases, though, what you're doing is you're using a very small portion of your current assets to secure a larger amount of liquidity upon your passing, and removing that from your overall taxable estate through tools like crummy provisions. Finally, a common roadblock to estate planning is a situation where you're a small business owner. And although you have concerns around estate taxes, maybe your largest assets are tied up in this business somehow. So there are strategies like family limited partnerships, which I don't have listed here, but are very common, that will help you to slowly gift the business through time while still retaining that control that you need. But then there's also strategies like what we have listed here, Section 6166 deferral, which will allow you to take the period that your estate has to pay off any potential estate taxes. We can extend that out quite a bit. What that does is it frees up your assets to accumulate a little bit more for your heirs and pay that debt down through time. Lastly, I'd like to talk about kind of one of the most important things a small business owner can do as it relates to financial planning, and that is the creation of a buy-sell agreement. So this is a document that is absolutely critical to protect your family, not only in the event of your passing, but it will also address the other what-ifs in life, such as disability, divorce, loss of a professional license, and any number of other things that we can include in there. Now, what's really important with the buy-sell agreement is that in addition to actually creating the document itself, so meeting with that attorney and drawing everything up, the strategy must be funded. So many individuals will actually work very hard and having those conversations to establish the framework, but they'll often forget to deploy all the necessary tools that are needed to ensure that that strategy works, which there's any number of ways that you can do that. So again, we could spend quite a bit of time on each of these and still not cover everything. So if anybody would like to spend more time discussing these and how they might relate to you specifically, please don't hesitate to reach out to us. But hopefully you found that high-level overview helpful. But shifting now down the line to gifting, Brandon, we've discussed some of the larger estate planning strategies here, but what are some other common gifting strategies that you're using with your clients to help them achieve their goals?
Sure. Thank you, Chris. So as Chris mentioned today, I want to cover some gifting strategies as well as some specific planning items just for Connecticut estate taxes and income taxes for current residents. So for 2024, you can gift any person $18,000 per year. So if you have 3 kids and 7 grandkids, you could remove $180,000 per year from your estate without impacting your lifetime estate exemption. If you're married, you can elect to split gifts and you can actually double this amount. If an individual gifts above this amount, you will need to file a gift tax return, and the excess amount will need to be deducted from your lifetime exemption. So for example, in 2024, the exemption, as Chris mentioned, is $13.61 million. If a single individual gifted $28,000, that 10 grand above the 18,000 exemption would reduce their lifetime exemption by $10,000 down to 13.6. So no gift taxes are actually owed until the full exemption is exhausted, but it is, you do need to file that tax return and you do need to report those gifts. Qualified charitable distributions are a great strategy and an ideal strategy for a client with charitable intent that also has large pre-tax retirement accounts that are subject to required minimum distributions. So if an individual is at least 70 and a half years of age, they can exclude from their gross income up to $100,000 per year if it's given directly to charity. For a married couple that both have IRAs that are both over 70 and a half, the exclusion will double to $200,000. Additionally, 529 plans are an excellent way to reduce an estate. Parents and grandparents can contribute up to $18,000 per year without any gift tax issues. 529 plans also allow for a 5-year front loading of contributions. So in 2024, a parent or grandparent could contribute $90,000 to each child's 529 plan without triggering any gift tax issues whatsoever. Finally, there are a few gifts that have no annual limits and do not impact the lifetime estate exemption amount. And these are gifts made directly to educational institutions, so colleges, for example, or to medical bills to hospitals or doctors' offices. There's no annual gift tax limitation, and it will not reduce your lifetime exemption regardless of the amount. So this is another great way for wealthy individuals to reduce their estate tax in a tax-efficient manner. Here I want to touch a little bit on specific estate and income tax planning strategies for Connecticut residents. So the Connecticut estate tax exemption mirrors the same amount as the federal limit of 12.92 for 2023. So we can touch a little bit again just on 529 specifically to Connecticut, which is referred to as the CHET, the Connecticut Higher Education Trust. So it's an excellent state income tax reduction strategy for parents and grandparents to fund these 529 plans. Connecticut residents can deduct up to $10,000 per year per tax return for contributions made to 529s. So assuming a client is in a 6% tax bracket, this is like receiving a $600 tax credit, which is pretty substantial. If the funded amount is above 10 grand, it can be rolled over and used as deductions in future years. So for example, if a grandparent set up 3 529s, one for each of their grandchildren, and deposited $5,000 into each account, they could deduct $10,000 in that year, and then they could roll over the remaining $5,000 to the following year. Specifically for the CHET 529, they do have excellent low-cost investment options through Fidelity. And in addition to receiving an income tax deduction, the investments grow tax-deferred and can be distributed tax-free if they're used for qualified education expenses. If the account is overfunded or the child decides not to go to college, it can be transferred to another individual with no tax consequences. Recent Connecticut legislation has also expanded the ability for employees of small businesses to save for retirement with the creation of the Connecticut Secure Choice Savings Plan. This is a Roth IRA that's set up through the employer with the same contribution and gross income limits for a regular Roth. For 2024, an individual with earned income can contribute $7,000 per year to the plan with a $1,000 catch-up if they're age 50 or older. Finally, Connecticut offers a long-term care partnership program for qualifying long-term care insurance policies. The way this works is if you didn't have a policy in place, you'd have to spend down all of your assets to almost zero prior to Medicaid stepping in to cover the remainder of your long-term care costs. If you have a qualifying policy, you only have to spend down assets equal to the amount that the policy has paid out in benefits. For example, if your policy provided $300,000 in benefits, you could maintain $300,000 of assets, and then at that point, Medicaid would still kick in to pay the remainder of the cost. So it's a good way to pay for your care and also preserve, assets within your estate that can then go on to beneficiaries. So there's a lot of interesting, planning strategies that we can implement, for you and your family's financial plan. So, please feel free to reach out in the future if this is something you'd like to discuss further. But at this point, we'd love to open it up for Q&A and see if there are any questions from the audience.
Really nice job. Actually, one question queued up quite nicely asking if they did want to get additional information, best way to reach us. I'm going to actually advance to another slide here while we're talking. There's some contact information for all three presenters here today. Additionally, as I mentioned earlier, once we officially conclude here in a minute or two, there'll be a pop-up browser with a link to a survey. And in that survey, you can indicate that you'd like a follow-up call from one of our representatives here to reach out to you. You just list your name and phone number and they'll make contact with you. So if there's any other questions, I'll just take a quick peek. I don't see any additional questions in queue. So I think with that, we went through quite a bit of information today. Hopefully it was helpful for all of you. We appreciate you all taking the time out of your day to be with us today. And hopefully you were able to learn some things from our presenters here. We look forward to having you at a future webinar in the first quarter of next year, which you'll get an email about that topic. But again, thank you again to our presenters. Thank you all for joining us. And that concludes. And if you can, just stay around for another minute and do the survey for us. We'd appreciate it. Thank you all and have a great day.
Thanks, everyone.
Thank you, everyone.